Okay, welcome back, guys. This is Robinhood Portfolio, episode 22, and today the portfolio took quite a bit of hit, down $16, with the after hours down total of $3. So we're going to talk about it all, guys. We're going to talk about the markets in general, how I feel about the market, and what I have been up to with my stocks. So the markets right now have been very volatile. Market volatility is back once again, and stocks are just going up, they're going down, they're going all just insane ups and downs frequently. But the thing I want to talk about, the thing I wanted to get to is that for the week I am down $32, and we can see these little peaks or valleys that you guys are looking at on the screen here. So they look like mountains in the background. It's up, it's down, it's just right now the markets are very unsure about these tariffs that are going on. A lot of bad news. There's a lot of uncertainty and dark clouds hanging over the market. And when that happens, there's a lot of rotations with cash, and all these big shots that are into these stocks. They start moving money around when people don't know whether or not to sell or to get out of a stock, or maybe just try to get ahead and keep those gains pushing. But with that being said, a lot of the tech stocks, the technology sector, seems to be getting hit the most. They have really been down. I think Apple's trending back. Amazon has been trending back. Like all the tech stocks, all these major big FANG stocks are going down, and it's just amazing just to look at all these stocks going down. But we're going to go ahead and jump into the portfolio. As you guys see, I'm not doing good, but the whole market, the Dow Jones is down, all the NASDAQ's down, everything is down right now. But this may be a good buying opportunity here. You guys are just looking at all the stocks into my portfolio. So we know about Apple, we know about Visa, also most of the stocks that I had in the previous video are still in this portfolio. But I had sold away PSX, which was Phillips 66, and I've talked about that stock in the last video, how I wasn't a fan of that average cost. And the thing is that I'm not a big believer in these oil stocks. I just think that right now is not the time to be buying these oil stocks. But there are a couple oil stocks that I feel like these could be good plays here, particularly Shell that I want to talk about here, and this is the reason why I bought I started a position in Shell stock. Right now I'm a total return of $4. I just bought this stock maybe about, I think it was yesterday, or I bought some more shares today, but down almost $9. Down $9, almost a 10% correction in the last 3 months, and there are a good blue chip, solid energy stock that continues to keep my diversification up, and they pay a pretty fat dividend of about 94 cents. So in total, if I hold on to my 15 shares, I would get paid $14, about $14 from dividends with this stock. It's a great energy stock that I feel is, I can buy more of this. I looked at Phillips 66, and Phillips 66 had I actually wasn't going to sell Phillips 66. I said that I mentioned in my previous video that I had put a stop loss on Phillips 66, and it hit my stop loss. So, when these stocks start hitting my stop losses, the computer says, oh, all right, well, it's down to a certain point. I want you to sell off all my shares. So I profited about $26 from Phillips 66 before I hit that stop loss, and it sold off all those shares. With that being said, I needed an energy stock because Phillips 66 was now gone, and I saw another hole in my portfolio. So I ended up buying Shell, a stock that is, fairly cheap. They're on sale, and they pay a fat dividend. So they had all three of those, intangibles. And I was looking at the news with Shell. Their blue chip stock, they haven't had the best graph here. just in comparing the total gains to Phillips 66. Phillips 66 has a better capital appreciation, but in particular, this almost a 30% crash with this stock, which happened back in 2015 when all the oil stocks were going down. So this stock can very well do it again. This stock is by no means exempt from total market crashes, but right now, I just think it's a good buying point. $65. I think the high was around $76, and I'm right. The high was about $76, and they pay a fat dividend. So it's a decent stock that I can buy a lot of shares of, and that's the reason why they are here. Shell, ticker symbol RDS.B, and I can buy more of this, and when this falls, I can just buy more, and I can accumulate shares, and I can get paid a fat dividend. So that's not bad there. I like the profit potential off that. So the portfolio has hit $15,000, and we are about $5,000 away from the goal, to which I've set, which is getting this portfolio up to $20,000. And if I can get up to $20,000, by the end of the year, I'll be very happy with that. But $15,000 right now, the markets are not doing good. A lot of panic and fear. People are selling off most of these stocks based off their emotions. There's one particular stock that I want to talk about right quick is Alibaba. I've been watching them. I know they're not in my watch list currently, but they have really been getting hit bad here. And I actually thought about jumping into Alibaba right now. They are on a terrible correction right now, almost a 20% correction. So that's pretty significant. It's almost a crash when we factored things. But I think this thing got all the way down to about $58, which were really, really attractive levels for a stock like this. Now, I understand that the tariffs and the uncertainty about Alibaba and the short-term risk that carries along with Alibaba, but I feel like if you buy onto the stock right now and you get into that discount, if you can just manage the tariffs and all the black clouds and the noise about Alibaba going back down to $150. I've heard as low as $150 with this stock that this stock can go down to. But if you hold on and you clear all that stuff out and you hold on for about a 5 to 10 year position, a major position, it could very well play off very nicely in your favor. Alibaba is probably my favorite Chinese stock, coming out of China. They just do a lot of cloud. They do a lot of e-commerce. The growth is certainly there as far as the statistics goes. They are almost $1 trillion company, and they have a very attractive price to earnings ratio. So I just wanted to talk about Alibaba right quick. That was a stock that I'm watching. I know I don't have it in my watch list, but I have a separate watch list on Seeking Alpha that holds just about every stock that you can think of, Amazon, everything. And stocks are trending back, you guys. Stocks are trending back. So, the markets are not going to keep going straight up, guys. You have to prepare your portfolios for days like this. We've seen the technology sector get hit the hardest. And, I think I had a comment on my recent video. Somebody said, why should I diversify? Why is it important to diversify? Why not you just buy just a whole bunch of maybe tech stocks or industrial stocks or health stocks, and then there you go. Well, this is the reason, because the technology sector has been getting hit pretty bad, and they had a little bounce back today. But look at Apple has been Apple's starting to trend back. Amazon's starting to trend back. All these stocks, all these high flying FANG stocks are trending back, and the money is being rotated out of these big FANG stocks, and they're going into stocks like retail. They're going into the stocks like oil and gold and materials. So every once in a while that the market will do this, and I think this happened last year. I think around this time last year, the market was starting to do this. All these tech stocks were starting to head down, and everybody was freaking out, and everybody was saying, hey, there's a tech correction going on, and blah blah, and this and that. So what I'm trying to say is that it's important that you put some diversification in your portfolio, and it doesn't have to be, insanely diversified. You don't want to be too diversified into other markets because that's going to, cut into your gains. But, just have a right balance of stocks. You need to have a portfolio that works together, if that makes any sense. Like stocks helping each other when the other stock is down. And I know that that really doesn't make any sense because, you're just putting stocks together and just looking at different market sectors. But, in the case that, the tech sector's down, we look at a stock like Costco. Costco's up 2%. They've been just trending up. They have been having a nice total return here for about a 61%, $61 return with a 5% increase. So what I wanted to say about Costco is that, when on days where the home market's down and everything's red, you look at a stock like Costco's that's up. So this is why you want to diversify. And Costco's been trending up a lot lately, and this is the reason why I got rid of Walmart and got into Costco, because even though Walmart is a fantastic company, they're everywhere, they're all in your face, and you shop there and get all these discounts. Costco has the growth, guys. They have the growth. Their membership, subscription memberships, and all this other stuff play an important role into how this stock keeps going up. And they're starting delivery. They're getting clever. They're becoming innovators as far as trying to get up there to Walmart's popularity. Like, I know that they're not as popular as Walmart as far as like being all in your face, but they have a loyal consumer base. If that makes any sense, they have loyal customers that. Some people, they don't want to shop at Walmart. They don't want to have to wait in these long lines and, have to get bothered by these little kids running around and running into them. And, parents are wondering how come this child isn't behaving themselves in the store, and the store is filthy. And just little things like that that people look at. And they say, man, I don't want to shop here. I want to shop at Target where the stores are cleaner, there's no lines, there's better clothing. And yeah, I might have to pay more, but you get what you pay for. You get what you pay for. I mean, hey, if I'm going to pay for a membership at Costco, then I don't have to go and wait into these lines and all this sort of stuff. And I've been inside Costco, many Costco's, and they've had their own share of line difficulties. And but you want to know what? Even though their lines sometimes are bad, I never see like kids running around in the store and clothes just on the floor. Their stores are always clean. Their stores are always clean. Stuffers in the right place. I don't have to worry about anything. They always have friendly customer service. If I can't find something, I could just walk up to anyone. And, I like that customer satisfaction. I do. So, Costco is trending up. It's a great stock, and I'm glad I put them into my portfolio for the long term. Another stock that's trending up is Starbucks. So on a red day, stocks like this, the discretionary sector is up. The whole discretionary sector is up. Retail discretionary services, all the discretionary entertainment, all these discretionary stocks are up currently. And right now for Starbucks, people are starting to realize that the stock has potential and it's going back up from their mini correction or flash crash sometime back a couple of months ago. It's a solid portfolio, guys. I know the portfolio keeps trending back in the after hours, but I'm totally fine with that because I know that I'm going to be getting paid dividends soon. And what I mean by that is that, I'm getting these fat dividends, if that means these big, giant, fat dividends that, pay $13. Look at this, 3M, $13 right there on a scheduled date. And I think next week. Look at a stock like Johnson & Johnson. They've been paying their dividends for the last 50 years. Dividend, $9. You can't beat. I love it. I love that. I know, but if you have like tons and tons of shares of Johnson & Johnson, you'll get paid a big giant dividend, which is just very, very attractive. You just can't beat that. You can't beat that. Next Energy. I know they've been up and down, but look at the dividend. That's another dividend. $11. So these dividends are starting to stack up. And this is free money. This is free money that protects your portfolio from days like this. When days like this, when the market is crashing well, I wouldn't necessarily say crashing, but when the markets are turning red and they're going down, down and down, you just look at your portfolio and say, oh man, I gotta put more money in there, blah, blah, blah. But these dividends, each dividend payment, it adds up. At the end of the day, it all adds up. And you can really make a good amount of money if you just hold on to your stocks, guys. Hold on to your stocks. Don't get emotional. Don't start screaming that the sky is falling and all this and that. Markets go down and markets go up. That's just what you have to do. Some people are day traders. The people that are selling off right now are the short term traders. They're these big shot guys that are trading options, and they're trying to make a quick buck. They don't have a long-term vision. They're day traders. They're in it to make the money and get out, and they're here to make thousands of dollars a day. I, on the other hand, am a I like to think of myself as more of a buy and hold investor, and when I have a significant amount of money just sitting there, I do like to put the money to work and have the money work for me instead of me working for it. But that's another reason why I put the Vanguard S&P 500 Trust ETF into my portfolio, because I had about $800 just sitting there. And I said, what am I going to do with this $800? Am I just going to let this $800 sit there, or am I going to put this money to work? Now, VOO touches a lot of markets. I've said this in the last video. They have a fractional percentage of Amazon and Microsoft and JP Morgan Chase, banks and healthcare. They just hit so many markets and they're so diversified. So, I don't mind buying a ETF like this and just, sitting around and sitting around and waiting, because when the markets start to go back up, I'm gonna profit. I'm gonna profit off VOO, and my goal is to swing trade VOO, particularly in the next 3 to 4 months. So in the next 3 to 4 months, I'm probably gonna sell off, and I'm gonna make. I'm gonna gain some money. I'm gonna gain some profit. But what I like about VOO is I don't have to sell off. I have a long-term vision to where I can just hold VOO, get paid a pretty good, nice dividend. It's one of the better dividend ETFs, and I don't have to worry about this an expense ratio that's virtually non-existent. The expense ratio for VOO it's barely. It barely costs anything to be in a stock like this that gives you so much diversification. So, I don't want to be too diversified, because again, I have so much diversification already, and I just don't feel like I need to do anything. But, VOO plays it plays into what I want to do as far as, swinging a stock, maybe about 2 to 3 months, and get those gains and keep this portfolio on the right path, if that makes any sense. Keep the gains flowing, keep the dividends rolling in, and the dividends will, protect me from days like this where I'm losing cash. When I'm down $16, when I'm down $30, when I'm down $45, I get the dividends that make up that loss. So if that makes any If that makes any sense to you guys, then yeah, hold on to your stocks. Don't get emotional. Don't sell. Don't panic. The sky is not falling. And the thing is that I would say just don't time the market. Do not time the market, because you trying to time the market selling all your stocks and in waiting. The markets can be green Monday. You can be missing out on all those returns Monday. Right now the market is going down, but we don't know how the rest. No one knows. No one knows how the rest of this week. Excuse me, not the rest of this week, but next week is going to play out. So hold on to your stocks, and you should be good. So let me know what you guys think about this portfolio. I know it's getting to the point where I don't have to make too many changes, but we're at $15,000, and my stocks still look good. I'm still in at very low average cost. So you look at a stock like Johnson & Johnson today, up 45 cents. Total return $168 on a red day. On a red day, guys, I'm up $4. So, do your homework. do your due diligence and get into those stocks that are cheap. I showed Alibaba here. I showed Alibaba, and you look at a stock like Procter and Gamble, still trending back up, but I still think that they're a good buy at that $81 range. Apple's starting to fall down, so all these tech stocks that are starting to fall back, and people are getting out. That's when you get in. That's when you get in. When people are losing their minds and getting out, that's when you buy. And you look at a stock like Alibaba, you look at a stock like Tesla. Everybody's getting out of Tesla. The sky is falling with Tesla, and they've dipped a lot. I think they dipped almost 25% these last couple of months. I think almost. Let me just take the look here for the last month. Almost 20%. In the last 3 months, almost 16%. So everybody's panicking. Everybody's getting out. And you, as an investor, need to look at yourself and say, all right, everybody's getting out. Where do I jump in at? I don't know where the bottom is because I don't want to time the market. I'm not going to time the market, but I look at things. I say, oh wow, a stock that's 16% on sale. That's something I gotta look at. That's something that I'm watching. I'm looking at bargains. I'm trading on value, great values, and I'm getting in low and I'm selling high. Those are the investment principles that have been taught down from generation to generation. And if you can master those principles and you can leave your fears out of the market, you should be fine. So I'm going to cut the video here, guys. So right now, the after hours have not been kind to me. But like I said, I just shown you guys about 3 dividend payments that'll make up all those losses. And just let me know how you think. We're up to $15,000, and I'll see you next time.